In this video, we're going to walk through Learning Objective 4, how to present long-term debt, in particular, how it relates to the fair value option. The fair value option. Companies have the option to record fair value in their accounts for most financial assets and liabilities, including bonds and notes payable. The Financial Accounting Standards Board believes that fair value measurements for financial instruments, including financial liabilities, provides more relevant and understandable information than amortized or historical cost. We're going to take a look at how we accounted for financial assets using the fair value method. We're going to take a look at our marketable securities. Recall, marketable securities are financial assets such as stocks or bonds that a company invests in. And an important factor influencing the fair value of financial assets, as well as that of liabilities, is changes in interest rates. Recall, rising interest rates mean lower present values, and falling interest rates will mean higher present values, everything else being equal. When we discussed marketable securities back in Chapter 4, or Chapter 5, we identified 3 different types of marketable securities: those held for trading purposes, those identified as available for sale, and those we were planning on holding to maturity. Trading securities can involve both debt and equity, and we will value them using a fair value option and classify them as current assets. Securities that we have identified as available for sale, again, can be either debt or equity. We'll use a fair value method for valuing them, and they would be classified as current or non-current, depending upon their maturity. Held to maturity financial assets can only involve debt instruments, such as bonds or notes payable, that we've acquired from another company. That's because they, unlike common stock or preferred stock or equity instruments, they have a maturity, so we can anticipate holding them until maturity. If we've identified financial assets as hold to maturity, we have the option to account for them at historical cost. Of course, we'll amortize any premiums or discounts, and they, of course, would be classified as non-current assets if they matured beyond a year, or current assets if their maturity was expected within the next year or operating cycle, whichever was shorter. Let's take a quick review of how the classification of our marketable securities impacts our balance sheet and our income statement. We'll take a look at how it impacts both trading, available for sale, and hold to maturity securities. Rather than accounting for trading securities at historical cost, we use the fair value option. If they've gone up in value, we will report an unrealized gain on the income statement. And of course, if they've decreased in value, we will report an unrealized loss on our income statement. We need to do this because our extended accounting equation needs to remain in balance. We can't simply increase the value or decrease the value of assets without also impacting equity. And we do this through the income statement by recording unrealized gains or unrealized losses. Trading securities, you recall, are those held by financial institutions typically, but also other businesses, that have been purchased with the intent to trade, in other words, buy or sell, with the hopes of realizing a profit. The next type of security we considered was available for sale. We purchased these not with the intent necessarily of buying or trading them on a regular basis to earn a profit, hopefully not a loss, but if the right opportunity came along or the need arose, we would be willing to sell these securities. So they're somewhere in between trading securities, again, those bought with the intention of trading in the short term, or those that we've classified as hold to maturity, those that we plan to hold until they actually mature. And recall, at maturity, we'll receive a bond or a note's fair par value or face value. So we won't have a gain or a loss. But rather, these fall somewhere in between. So we will use the fair value option and account for these at fair market values and report an increase in assets or a decrease in the value of the asset. But we don't want to record the unrealized gain or loss directly on our income statement, because recording these gains or losses on our income statement just introduces additional noise on our income statement. By noise, I mean gains in one period are likely to be offset by losses in the next period, and we're not really giving investors any information or additional information about the long-run earning potential of our business. That's different than classified, or securities have been classified as trading, because there, part of our strategy or our operations is the buying and selling of securities. So we will record unrealized gains and losses on securities that are available for sale as part of other comprehensive income directly in the equity section of our balance sheet. Finally, securities we classify as hold to maturity. We keep accounting for them at historical cost. We'll amortize any premium or discount that was associated with the security, and we don't record regular increases in revenues, gains, or decreases, losses. Let's take a little bit closer look at these unrealized holding gains and losses that we report as part of other comprehensive income. We've got our good old-fashioned income statement where we report realized gains and losses as well as unrealized gains and losses on trading securities. But those securities that we've classified as available for sale, we will instead report those unrealized gains and losses directly in stockholders' equity. And so it becomes part of our other comprehensive income. If we were to look at our statement of stockholders' equity, we would have common stock, perhaps retained earnings, as well as accumulated other comprehensive income. To break that down a little bit further, this is how sort of an extended or expanded statement of stockholders' equity would look. So now let's get on to accounting for liabilities such as bonds and notes payable using the fair value option. A company may make this election or can continue to account for them at historical cost. So if a company chooses the fair value option, they report those notes and bonds at fair market value. In addition, they will report unrealized gains or losses as either part of net income or as part of other comprehensive income, depending on the specific circumstances that cause the increase or decrease in the value of that liability. And again, recall, just like marketable securities, one of the most important factors influencing the fair value of financial assets and liabilities is changes in interest rates. Rising interest rates go up, lower present values. Falling interest rates mean higher present values. Let's take a look at an example. So the Edmund Company issued $500,000 of 6% bonds at a face value on May 1, 2020. Edmund chooses the fair value option to account for these bonds. At December 31st, 2020, the fair value of the bonds is now $480,000 because interest rates in the market have increased to 8%. Notice the increase to 8%. Interest rates rise, present values decrease. How will Edmunds account for this change in fair value? Well, Edmunds will debit or reduce their liability. So they'll debit bonds payable by $20,000, and of course they need a credit, and they will credit an unrealized holding gain, and it will become part of or reported on the income statement. On the other hand, the FASB now requires that any change in fair value related to changes in the credit risk of the company be reported as part of other comprehensive income. So if a company's credit rating falls, it's likely to have to pay a higher interest rate. On the other hand, if a company's credit rating improves, its interest rate will fall. Any portion or change in interest rates related to credit risk, and again, this is going to be often difficult to measure, will need to be reported as part of other comprehensive income. Let's continue on with an example. Now we assume that the change in Edmund Company's fair value on its bonds is due to its credit rating dropping from AA to BB. In this case, Edmunds makes the following entry to record the fair value change in other comprehensive income. It's the same debit to bonds payable to reduce the fair value or reduce our liabilities, but now the gain, unrealized holding gain, is reported as part of other comprehensive income in the equity section of our incomes of our balance sheet. So if it's due to simply a change in interest rates, market interest rates, it becomes an unrealized gain or loss on the income statement. On the other hand, if the change in interest rates and related change in fair value is due to changes in credit risk, the unrealized gain or loss becomes part of other comprehensive income directly in the equity section of the balance sheet. Let's take a look at a few examples. The Marlin Corporation has elected to use the fair value option for one of its notes payable. The note was issued at an effective rate of 12% and has a carrying value of $19,000 on January 1, 2018. During 2018, interest rates rose, not related to Martin's credit risk, and the fair value of the note is now $18,000. So again, interest rates rise, fair values decrease. So it's gone from $19,000 to $18,000. We're asked to prepare the 12/31/18 journal entry to record the change in the fair value of the note. We're going to have a $1,000 decrease in notes payable. So we'll debit notes payable for $1,000, and we will record an unrealized gain of $1,000, and that will be reported on our income statement. During 2019, interest rates dropped, again, not related to Marlin's credit risk, and the fair value of the note is now $20,000. So interest rates go down, fair values go up. Prepare the 12/31 journal entry to record the change in the fair value of the note. Our note has gone from $18,000 to $20,000, so we have an increase in our liability of $2,000. So we'll credit notes payable for $2,000, and we will report an unrealized loss, and that will flow through to our income statement. In 2020, interest rates rose, fully related to Marlin's credit risk, and the fair value of the note is now $19,000, and we're asked to prepare the journal entry on 12/31/2020. Again, interest rates have risen, fair values go down, so we're going to decrease notes payable. But because this is solely related to changes in our credit risk, we will report the unrealized gain as part of other comprehensive income, not on our income statement, but rather directly in the equity section of our balance sheet.